Hey everyone, welcome to another episode of the Diff, an Energy PM's take on energy markets. It is Monday, July 10th. We're very excited to have another episode coming out for you. We are going to turn our attention south this week. Does Bocas Refinery headlines before the July 4th weekend entering startup phase? 340,000 barrels a day, a brand spanking new refinery built by Pemex in Mexico. We wanted to use this to have a two-pronged discussion. First, this is going to be a big use of mine crude, 340,000 barrels per day of nameplate capacity. That is a big chunk of heavy sour oil that is now going to be spoken for within the borders of Mexico. Adds further to an API squeeze that is occurring globally and very much so in the Gulf of Mexico. And then we're going to use it as a look to the U.S. gasoline and distillate export markets. Mexico is an extremely important export market, especially in gasoline. Nameplate is 170,000 barrels a day of gasoline capacity. We're going to help you contextualize how important that is for the U.S. and what some of the ramifications might be for the U.S. gasoline market, both on an export basis as well as internally. So, Greg, welcome back.
Hey, John.
Ready to rock and roll. This is exciting. Last show, we spent a ton of time on the dynamics up north, and that introduced a lot of heavy versus sweet. And it was just very interesting timing that this came out as we were thinking about what to do for this episode, that people had been waiting for the official date. And obviously it's too early. The products aren't going to hit market anytime soon, but they are introducing oil. And they are giving some sense of visibility to having this operating at full run rates, potentially by the first half of next year. I imagine they would love to get this thing up and running before the peak of the U.S. summer driving season in 2024. So my guess would be that we're going to look for full run rates sometime within the next 6 to 9 months, barring something occurring. So let's start to think about what this means. And I know you spent a lot of time looking at production out of Pemex and U.S. imports of crude oil. Let's start there. This is a 340,000 barrel per day nameplate capacity refinery, and it is configured, according to press releases, to run on 100% benchmark mine crude. So what does that mean in terms of the overall heavy sour market in the Gulf as this refinery ramps up to nameplate capacity?
Yeah, real broad numbers here. It's kind of reminiscent of our last discussion about Canada, and that this marks what could be an inflection on the trends domestically. We'll start on the upstream side. Pemex, I'd say the narrative has been one of neglect and slow withering away pretty much across the asset base, upstream and downstream.
And we had an unfortunate reminder of that the last few days with the tragic fire on the production.
That's right. Another manifestation of that. And it kind of highlights the challenges they've had in the last 15, 20 years. By broad strokes, Pemex upstream production has gone from nearly 3.5 million barrels a day in the mid-2000s, all the way back down to 1.5, 1.7 as of late. Now, trajectory, it looks like it's kind of stabilized here in that 1.5 plus or minus range. And as always, there are ambitions of bringing that number back up to the 1.7, 1.8 range. We'll see how that goes, but it seems to have stabilized for the first time in a while. Similarly, on the downstream side, as you mentioned, another story of neglect. The refinery system has struggled with chronic issues, chronic downtime. Back in their heyday, again in the 2000s, the downstream system across Pemex was making about 1.4 million barrels a day of product. And in the last 5 years, that's really come down to, it's under 1 million, call it 600,000 to 800,000 barrels a day, depending on which facility is able to keep things running. So if we're running in the 700,000 barrels a day on refined product side, all of a sudden we're going to look at another almost 400,000 barrels a day refined product. There's a serious disruption at risk here, the broader Atlantic Basin, Gulf of Mexico region on upstream and downstream side.
Yeah, absolutely. And as as we highlighted last week, focusing primarily on the last episode, focused primarily on the WCS market, the U.S. as an overall energy ecosystem isn't matched on what its refineries would like to purchase and run on and what it actually produces. And you put some very interesting stuff together for this week just to help us highlight it in terms of the crude imports we have and the API. So why don't you just help us contextualize again, and also serve as a reminder if you listen to the last episode, where the APIs of our import basket tend to fall and where we tend to focus in terms of purchasing imported crude in the U.S. refining complex.
Yeah, let's do a quick run through. As you and I were kind of framing it earlier, 25 years ago, we were running out of crude, so our entire industry started looking abroad, sourcing the next leg of growth because we were running out of it in the U.S., and that meant going to the heavier sour barrels that were coming. LATAM was a big one of that, of course, the Middle East as well. So the blended input into our refining system went from the mid-30s, call it 33 API, back in the 80s, all the way down to 30 in the 04, 05 range as we really took in a heavier crude slate. But since Shale took off, we've displaced a good chunk of that, and we're back up into the 33 range. We've kind of round-tripped it here as Shale has displaced some of those heavier barrels that we've been importing. Now, where do we get it? One thing that I was looking at was kind of interesting. In the lower 48, which includes even California, Gulf of Mexico, we produce around 40 API blended, and I know you'll want to slice and dice that. But that 40 API needs to be contrasted with the 33 API that we take into our system, meaning our production is a lot lighter than what we process. So maybe domestically, where do we get that heavy crude? Because it's dying on a vine, really. It's effectively California, which has just been on a very linear shrinkage from 500,000 barrels a day 8 years ago down to, call it 300,000 barrels a day. That's been our steady source of 30 degree or less. The next big chunk is the Gulf of Mexico, and that has been pretty stable. And now not the whole.
Yes,
it is.
Our best asset by far.
It makes 2 million barrels a day, maybe half of which, not even half of which is this 30 degree API, right? So even a good chunk of our Gulf of Mexico production is still contributing a higher API to the overall crude slate.
Yeah, and those loop comes out every month with their Mars blend stats, and it always lands somewhere between 29 and 31, and somewhere in the high ones for sulfur. And so there's a reason that seems to be where the Gulf Coast wants to be in terms of its overall API and sulfur match.
Right. And then you were asking about the imports. It's interesting to me, in the 2000s, we were importing 10 million barrels a day of crude, and that number has been cut almost in half with Shale. Yep. And we've backed out a lot of the lighter components in that time frame as we've displaced with Shale, but that has found us growing our dependence on Canada, as we discussed in our last episode. And so Canada is our biggest import source at 3 million barrels a day, and number 2 is Mexico. Call it 500,000 barrels a day, because we're again looking for that heavy barrel, and Maya fits the bill. It's some of the good stuff.
Yeah, it's about 22 API. It's slightly under 4 sulfur, and all those big boys, all those big machines, Marathon, Valero, all those guys, Lyondell, Houston, are all configured to take it. So it's definitely been part of the diet down there for a very long time. But to your point, 600,000 barrels a day, all of a sudden, we've got a refinery open with 340,000 barrels a day. This is a huge chunk. Mm-hmm. And we're already seeing with the actions that Saudi's been taking on cutting OPEC barrels, I don't think it created an API deficit, but it is accelerating it and exacerbating it. And something like this certainly, which again, the refiners in the south part of the country, it's not like they didn't know this refinery was coming online. Obviously, it's been an open question. Pemex has a whole host of issues internal to Mexico, as well as just the complications of opening any refinery. They're big, complicated machines that operate at very high temperatures. So it's not like opening a lemonade stand. But if you do get visibility on it, all of a sudden, the day of reckoning is here, so to speak.
Mm-hmm.
We're not going to have any bigger fight. Definitely a bigger fight.
Yeah, that's right.
And so I think that what we touched on last time with the API wars, with WCS hitting the water in the Pacific, you've now got Mexico, which already, by the way, and I think we need to mention, had been increasing refined products production. When AMLO was elected, that became a huge cause for him, which, by the way, I agree with. I do think that is correct. Pemex needs to address its refined product system. It's been one of the biggest problems for them. But obviously, they had some fires this year, to your point about a lack of tender love and care over the past decade plus. But they had already been increasing their refined product production this year, which was adding to margin pressure in the Gulf. But this certainly doesn't help, and it adds to the urgency of Venezuela crude coming back. Chevron obviously is putting a lot of effort into that, and it just exacerbates what you have going forward. Yeah, and we started seeing it this week, right? Smerger reports of $3-4 a Brent. All the Brent grades. So for the guys who are buying anything on the water, it's already getting tough. And as we come into next year, I don't, no crystal ball on what OPEC policy is going to be. But as we come in to the end of this year, beginning of next year, it would be very hard to paint a picture that's better for the guys that are short heavies in terms of that aspect of their business. Would you be able to paint?
No, I agree, man. It's interesting how these two big catalysts, north and south, seem to be lining up at roughly the same time. And Dos Bocas or Olmeca is going to be, they're turning the machines on now, but they really expect to be up and running full bore early next year, according to press releases over the weekend. Right about the same time.
I'm sure they'll try to hit summer, yeah.
Right about the same time that TMX is going to be ramping up to full capacity as well. I mean, it's going to be quite a shock to the system. You should see some early flows, right, as they're ramping up some of the purchases and line fill, but it's coming, and we're closer now than we've ever been to this disruption in the heavy sour market in the Americas.
While we were getting ready, it hadn't updated yet, but since it just did, I mean, the last read off of Valero for this week, my weekly, which I put on Twitter, don't believe, if you don't believe me, believe Valero. They've got Brent West Maya down in the Gulf at finally sub $10. I mean, to give people an example of how much this diff had been available as an arb for the Gulf Coast guys recently. And obviously with the price of natural gas, the heaviers became more expensive to process. But in March of this year, it was $19.30.
It's an incredible move in a short period of time.
So to your point of 650 to 700,000 barrel per day of imports and a $10 move, that's big. That is big. And it is part of the reason that I think it's going to be very interesting for energy investors to model out who gets what and who's winning and who's losing. And it does create upward pressure, the gas prices, diesel prices, as all these things. I mean, Brent less Houston on Valero's latest update for the week was $6, and we've even seen quotes that it's now even close to $3 down in Houston. So it is already the ocean's getting real.
It's really going to show up because I'm looking here, eyeballing it, call it 2/3 of our crude imports are 30 API and below.
Yep.
That's a big deal. When you drop from minus 19 to minus 5, big deal.
Yes, it's a huge deal. It's a huge deal. And as I've been highlighting a lot, sour spreads, you got to look under the surface. NYMEX is fun to look at. It's very informative, but it's a financial proxy, and you got to look under the surface right now. It's a frustration, and this will dovetail into our argument on the points we're going to make on Shale. It's a frustration for U.S. investors because, at least on the long side, there's not a lot of readily available ways to play this where you get a lot of leverage. And especially not with U.S. domiciled companies. So if you're looking to not take currency risk, if you're looking to buy something, now the IOCs, as we've talked about on this show, obviously are the ones with the most exposure. The IOCs are the ones operating in the Gulf. Exxon, Guyana, that's medium sweet. Medium sweet is a precious commodity. Shell has big exposure in Brazil. Equinor lives off these, right? Equinor is having a field day right now. If you follow the prices of Sverdrup and the North Sea grades, they're on a rocket ship right now. So there are certain folks that benefit, but it's hard to say, okay, this, unlike our WCS conversation, where I think investors would probably be able to find one or two more examples of big leverage to that. It's a little harder here because of who owns the oil, where it's housed. Is it, if you're in Exxon and you're massive, if you're in Chevron and you're massive, it certainly helps, but it doesn't create a huge step change. And, I think we've seen over the last week, everyone's just like, well, screw it. I'm playing it with Shale. I don't care. Oil, I guess we seem to come back to this, right? Oil's oil. I don't want to know. I refuse to know the difference between any barrels of oil. I don't want to know who's buying them. I am playing Shale on this because if I don't play Shale, I got to tell my boss I don't have any other ideas. And it's difficult. And so, I took a stab at the API gap, and I think that's going to be a good conversation for us to have. You mentioned, where do we make it? And then obviously the EIA is kind enough to put out the L48 production and give us broad API parameters, not specific. And obviously you can go county by county, but in the interest of brevity on the EI data, if you strip out the Gulf of Mexico and California, as you said, I have my estimate on what L48 production would be is roughly 43 API. And so we're talking about losing 22 API barrels on a consolidated system that right now is living between 33 and 34, and that's almost as sweet as it's ever been. And so if you look at what comes out, and all that growth in the last few years has been out of New Mexico. And New Mexico, the prior peak, according to this data set, was in 2019. All their growth has been above 40. They've grown 808,000 barrels in New Mexico over that time. And all of that is above a 40 API. And we all know that's 45 and above. There's a reason Enterprise is at 42.5. There's a reason there's now a West Texas light grade. And so I struggle to see. Shale can't respond to this.
Well, they can. They can. They're not going to do it accretively.
Yeah.
But what you're saying is that the U.S. API production base, even if you include California and Gulf of Mexico, is going to keep heading higher and higher because all the growth is coming from not just a little bit higher than what we need, but much higher. We're going to continue to force the challenge for the refiners to source these other barrels because they're going to have to figure out what to do in the absence of more heavy barrels because all they're getting is the light stuff.
All they're getting is the light stuff. And again, you can change configuration, but it takes capital and it takes capital and it takes time.
Yep.
And those are the two most precious commodities on earth, right? Your capital and your time. And so we're asking everyone to kind of pony up for it. And the market's telling you, look at how Brent Tobias behaved. Look at the WCS diff, the sour diff is screaming. The market's telling you it's willing to pay you for heavier barrels. And now it's going to figure out how the heck do we respond. Now, the guys who obviously have loved this and are understandably are the offshore oil field services guys. Those stocks have just ripped. Day rates have continued to go up. This is, when you think about it, Christmas for them. And they've been on Christmas for a very, very long time.
It's been about 10 years.
It's been a very, very long time. You look at these charts, hey, rings up, 50%. Well, okay, let's take that chart back 10 years. Oh my God, it doesn't even register. I'm not making any sort of stock recommendation or any sort of price target, but just to get a look at how much that sector has sunk.
Yeah.
Well,
the narrative since 2010, 2011 was that we didn't need offshore international because we had North America. We went from 5 million barrels a day to 13. But that's over.
It's insane. It is over. It is over. And so what's going to be interesting here in my mind, we've already seen news articles about, refineries in Southeast Asia, bidding down WTI Midland in the water over there because look, we've got cheap naphtha, we've got cheap propane out of the U.S. We keep flooding the water, and I think an underappreciated headline from the last week was that Saudi cut OSPs on propane. Mm-hmm. So they're aware of, like, we've got the heavy molecules, you don't, so we'll raise that. And you guys are flooding the world with these light ends. Yeah. We'll just keep our price low there.
We're going to compete with you there.
So we'll compete with you there. That's fine. Well, okay, yeah, sure, game on. And so you just continually are incentivizing refineries over there instead of cracking a full barrel to say, okay, well, if I'll have to overpay for heavies, but maybe I can get some of the discount back because propane and butane and bid down naphtha and do all these things rather than increase the number of absolute barrels I have for demand that doesn't seem to exist. So it's going to be a really interesting thing to follow. Again, your point about it happening at the same time. I mean, this is shaping up as line fill on TMX at the end of the year and sales in, say, Q1. And this refinery ramping probably over the course of the fall, winter. And like I said, I have to imagine they would love to get this up and running before the peak of summer driving season
24
in 2024. Because one, that's when you make the most money, and that's when you're going to be able to move the most products. So, it's going to be interesting. A couple other stats I know we wanted to throw at people for how much it is, and we could talk about the product market now. Mexico and Latin America are massive for the U.S. refining complex. So the flip side of the coin, as you mentioned, from shale growing and kind of letting us source more barrels internally, has been the dilapidation of the Latin American refining market has allowed U.S. refiners to continue to purchase the volumes of oil that they do. Mexico is a massive gasoline market. In 2022, it was over 50% of U.S. gasoline exports. The EIA put them at 435,000 barrels per day. And it is the only country according to EIA data, in 2022, that was more than 50,000 barrels a day.
Yeah.
So, and I apologize, I misspoke. It was 483,000 in 2022. So you're more than 50% of gasoline exports. We're now talking about 170, assuming that we reach full rates on Olmeca, that comes out of that. And there's no natural home for it. The global market is big, but in terms of just the ability to push it right next door to your neighbor, what's the cheapest, easiest thing to do? If you're Valero talks all the time about their export capabilities. They stick it on a boat, short trip, bang, it's right there. Well, all of a sudden, that guy is saying, look, I don't need as many. I'm making my own now. And by the way, I'm also not sending you the oil for your refinery that you used to get. So you got to find somewhere else. And obviously, you're going to just start dumping it wherever you can. Or maybe you turn it north. I don't know. What are your thoughts about the dynamic?
No, I agree, man. And, when I kind of zoom out, it's just, I keep coming back to this change and the structural change and the dynamic that's been in place since shale really took off. And U.S. refined product exports, I'm just counting the big three, gasoline, distillate, and jet, went from 600,000 barrels a day pre-shale to 2.5 million barrels a day. That is an enormous change in dynamic. And what has been so relevant, a huge part of that, as you flag here, is a lot of that's gone to Mexico.
Oh, yes.
We went from near zero in the 2000s to 1.5 million barrels a day of refined products to Mexico. And if these guys are going to supply now in-house 400,000 barrels a day of that, that's just a huge chunk of global market that's going to evaporate if this thing comes online and they start supplying internal. And what are they going to do?
And not to mention they've been ramping at their other refineries, which again, unfortunately, is exactly on fire. So they still have some CapEx they need. But yeah, I mean, you can go to Valero talks about this all the time. And this is obviously not a stock recommendation of Valero, but it's in their deck. Again, if you don't believe me, you listen to Valero. And they, on their numbers, Latin American refining runs in '09 were just overall Latin American 6.6 million barrels a day. That troughed in 2020 at 3.7. So that is the gap. And they say 88% of U.S. petroleum product exports end up.
That's the gap we filled.
That's the gap we filled.
With our shale.
With our shale. And so that was such a powerful tailwind for the shale producer because refining run rates stayed high. It was a massive tailwind for the U.S. refining system because as they overproduced, they were able to find export markets that were all of a sudden losing their ability to serve product to their own customers. And again, that appears to be reversing. It's obviously not going to happen in a straight line. When you have a Pemex that has woefully underinvested and looted its own system for a very long time, they're not going to be able to just immediately U-turn. But this is a brand new refinery. Any incremental move, since the base is so low, is going to have a huge ripple effect right now. And so, again, we've been operating under this system where U.S. refineries can run at sometimes irresponsible run rates and there's no ramification. U.S. shale can produce oil at often irresponsible levels and there's no ramification. We can pursue policies that limit Gulf of Mexico drilling with no ramification. And those are all reversing. You mentioned Gulf stayed steady. I mean, it's amazing the quality of this resource, how few rigs we've been running on this thing really since Deepwater Horizon?
Yeah.
And the political blowback from that. And we've just been kind of maintaining, and the thing just keeps pumping. It keeps pumping, and we're bringing stuff on now, obviously, so hopefully that'll reverse a little bit. But that is the resource we need to incentivize more than anything. We got to, we don't need 600 E&Ps in the Permian running 2 rigs, drilling 52 API in the northwest corner of New Mexico.
Because the buyers of crude globally are not asking for it. They want the Gulf of Mexico barrels. They want the Mexican barrels, the Venezuelan barrels. That is where the global refining slate has shifted in the last 10, 15 years. It's not just us.
Yeah, absolutely. Absolutely. And they're bringing more on to accommodate it. And obviously, if you're building a refinery in Southeast Asia, you're building one in India, or expanding one in India, you're going to configure to the closest oil. Closest oil is OPEC oil. It's not 50 degree. I mean, yes, there are some grades like Tapis that are extremely valuable and like Van Gogh coming out of Australia, but the bulk of your oil is coming from OPEC and the bulk of your oil is going to be medium to heavy sour. And so that's what you're going to be built to take.
That's where you got the visibility.
And yeah, absolutely. Absolutely. So I think it's going to be really interesting for shale. I think, and I don't think any of us can pretend to have an answer, but especially as they keep drilling and producing more of the propane and butane, which allows these buyers to substitute away from buying the barrels of oil. I'm really fascinated, absent a geopolitical event, to see how this heavy rally goes. I definitely think it has legs. The legs are being exacerbated, obviously, by Saudis. So to the extent KSA decides, hey, we still like OPEC cuts, but we're going to take back the 1 million barrels. Obviously, that could cause a delay. But in general, I feel like this is a structural problem. And we have 2 massive things. We have a refinery in Mexico, and we have a pipe in Canada that are opening independent of whatever decision KSA makes. And those are very real. And I think it would be a mistake for people to think that what's happening right now is just, Saudi took 1 million barrels of their own stuff off the market, and so it's sitting on boats, which it is. And I think, and so there's a difference between the absolute price of oil and the relative price of oil. And I think there's a strong argument right now that the relative price, the rally in the relative price of heavy sour, relative to the price of light sweet, might be at the beginning of a multi-year cycle, because it just takes too long to bring this stuff. I mean, Exxon is obviously taking stuff up. Guyana, with the Guyana, and Sverdrup keeps growing. But when you look at who's losing what, a lot of that API is getting converted into product. And so you could have a product glut and an API shortage,
Right.
neither of which the U.S. energy complex are built for. The U.S. energy complex is built for, we can pump as much of this light stuff as we want because we make as much gasoline as we need because we can send it all to Mexico. That's really what's happening.
Look, man, earlier in the pod, you said that it's a little bit frustrating from the investor standpoint because there's no direct way to play this. There's a caveat to that.
By the way, I said on the
long side because for you're training a really good short thesis for something else.
Hey, this as a reminder, folks, the Diff is not investment advice, and we do not produce estimates or stock recommendations. But yeah, I mean, it's crazy to think about, and especially given that we're only a year and a half behind the invasion of the Ukraine, where everyone can reset back to the whole U.S. has total supremacy. Every U.S. refinery is worth 5x replacement cost. There's global shortages of this, and we're only a year and a half in, and it's like, guys, if you didn't pay attention into 2022, I guess it felt right, but this is stuff that was in progress, and just because it got paused doesn't mean that everyone forgot.
So humor me, John, as I was kind of going through some of the prep here. I didn't even realize this resource existed, but Exxon, Chevron, Equinor, Shell, they all post crude assays for all the crudes they trade. It's a fascinating resource. So
I've lived on
no idea. This was great for me. So recap for me the areas that you are aware of where you're going to see heavy sour production growth. I heard Guyana, KSA at their discretion. What else?
Yeah, I mean, so the beauty of Guyana is that the Liza grade is sour, but with the sulfur cut so close to 50, the VGO and the resid cuts are not what you get out of, and that's really the trick to the medium sweets. And Sverdrup, like they've got, the tans are low, like that oil is just wonderful, but you don't end up with the real penalty on heavy sour barrels, which is if you run the penalty to heavy sour barrels, if you run it through a simple refinery and end up with a big resid cut, which that refinery cannot process, the sulfur level of that resid is extremely high. And so you have a very limited audience of people that can take it. Medium sweet, the beauty of that is the penalty for a simple refiner to run that medium sweet is so much lower because the resid doesn't have nearly the sulfur that you do out of the really healthy stuff. You're getting growth out of Guyana. We're going to get growth out of the Middle East. Saudi's going to grow. Kuwait is going to grow. Everywhere else, I mean, again, Petrobras is going to grow its medium sweets over time. Everywhere else, there's a heavy sour. You're in a lot of places where, who knows? Like, you're starting to talk about big providers of that are Iraq, Iran, Mexico. Can Pemex ever turn it around? I mean, these resources take a long time to develop, so not in any short order.
Yeah.
I mean, what were you thinking?
It was just striking to me where the crudes are. So apart from the sedimentary basin in Canada, your oil sands, I'm looking at offshore Canada, not going up. Yep. I'm looking at Angola.
No. At Bay du Nord.
At Bay du Nord was canceled for the second time, as we talked last week.
And that thing should be just I know it's got a high operating cost, but talk about just a perfect gold.
See, it's North Sea, Balder. I mean, you got a handful of them in the North Sea, Chad, Bonga, Nigeria, Usan. None of these things are growing. As I keep going up my list of APIs, they're not growing. So the growth that you're talking about is on the margin, while the base, ex-Saudi Arabia, is shrinking. So I agree with you. I do think this is a long-term structural challenge for the market, these heavy barrels.
And the other side of that, I wish I'd opened up the MOMR, but the other side of that is the heavy guys are increasing their refining capacity. So Al Zour, Jazan, all these places, the Middle East has, I believe, over 1 million barrels a day increase of total product production just year over year.
Refined product.
So, so, there was obviously a lot of this was catalyzed by IMO 2020. The desire of OPEC and its customers to get more heavy barrels into the refineries that can take it, for UAE and Kuwait and Saudi to be able to release a few more of their, there are some sweet barrels, or I shouldn't say sweet, but far less sour. And obviously Raban has turned into an exchange trade product. So to the extent that you can take UZ or other grades and put them into a refinery and release more Raban, which has that is a sour but not really type of grade. And so that is much more palatable on the water. A lot of these things were in motion for the heavy sour producers to capture that diesel arb, to capture all the other arbs themselves, rather than putting it in the water and leaving it for somebody else. So that was already in play. And then you add in the fact that the production declines and all the different things, we're ending up with a massive mismatch of who needs what and where. Meanwhile, we've got too many people churning out too much stuff. So you create compressed product spreads and you create a product glut. So there's all sorts of pain to be felt across the board from everybody. And I think this goes back to, you've always said this, the maturation / decline of U.S. shale. We're not showing up to the party with the right products, but in the meantime, the world does need our gas and NGLs. Those are really the things that the U.S. can provide that are actually a substitute. That other people, like the Asian refiners, love the fact that we're just exporting in 40%, 50% growth on our exports in propane, butane. They love that. Love that. They'd be like, look, just keep growing that. Stop sending us your crappy oil. We don't need it. We've got the heavy over here. Keep sending us the light ends. And we're like, no, we're oil companies. That's what the slide deck says. That's what the slide deck says, and that's what people want to hear at the conferences. And I think that's going to be interesting how we transition. I think we talked about last time about a suite of products. We've got to go to that mindset, where we're not just killing ourselves for this one oil production.
Killing ourselves meaning giving away 50 to 2/3 of our production stream.
Yeah, let's just overproduce gas and NGLs and eat ourselves alive and wreck our balance sheets. And that, as they say in the biz, is a segue.
Well done.
Because we did want to, we had one more thing we wanted to discuss. So we probably, I think we did a good treatment of what's going on in the South and relating it to what's going on to our neighbors on the North and the global market. But an issue that has come back and is a favorite of all of us who have traded the U.S. energy space, cost of capital. You did a lot of deep dives for us about recent M&A. Again, as prices have declined, as that BOE you mentioned on a prior pod, the aggregate BOE has been cut in half in the U.S. from 70 at the peak in 2022 to 35 recently. It's obviously a little higher right now with CL running up a touch, but not much. So we've had folks issue bonds at ever higher rates. We've had double-digit coupons, and we've even had some smaller companies admit publicly that they're perhaps reconsidering even issuing or refinancing bonds due to potentially high interest rates. So where do you see us, and what are your thoughts on the cost of capital for the shale industry as it turns into a 3x M&A business, and what U.S. investors should be thinking out going forward? I mean, because everyone's got to be chomping at the bit to get into a 3x business that is a 12% cost of debt.
John, when I started on the buy side, that was a buy signal, was 3x. Like, you got to buy it. It's 3x. Yeah, that actually was the mantra, and it worked at times. But things are cheap for a reason. It's something we've to appreciate, some of us, in the last 5+ years. What kind of sparked this one, and you and I had to read this press release a few times. I haven't been following this company closely. I knew of it. I know of the asset base, but I'm not an intimate insider here. But it was High Peak, HPK,
Yep.
who last week came out with a press release that said they were evaluating whether or not they were going to refinance some notes. They had previously put out a press release saying they were going to refinance. This was an interesting case study, especially for me, again, who hasn't followed it intimately, because earlier this year, towards the beginning of the year, High Peak came out and said they were considering strategic alternatives. Your classic, we're putting ourselves up for sale in code. Stock went to 30.
Thank God. Thank God I was not on the other side of that.
It was a rip. And, it was a press release. Earlier this month, stock was at 10. It's rallied here in this latest wave here to call it 14 and change.
Mm-hmm.
So it's gone from this company who said it was putting itself up for sale has gone from 30 to 14. I think that alone is worth just kind of mulling over. But
are you telling me the decks weren't getting a good response and that the bar scene in Houston was not whispering a very...
I think it's fascinating, John, that a company can neither sell its equity nor its debt. Not a great sign.
Yes.
There is an element of urgency here.
This is why you listen to the Diff, folks. We give you this hard-hitting insight. It's true. I mean, it's funny. I'm not laughing. You're absolutely right, because it's the simplicity of it. Like when you just say it out loud, they can't sell debt or equity.
Where do I sign on?
Yeah, exactly.
They were trying, there is a clock ticking here. They do have notes. They made some acquisitions last year. They have been, bless their hearts, they've been trying to cobble together an acreage position in the far northeast corner of the Midland Basin, where some operators have had decent results. It is not your core. I don't know that you would call it tier 2 or tier 3. I don't care about the designation, to be honest. I know it's far from core. Yeah. But they've got 2 notes here, each $225 million, that are due, one due in February of next year, one due in November of next year. So these guys are aware that they can't pay that note off with cash when it comes due. So they've got to get ahead of it. And they can't. They cannot refinance. It was a 10% note when they placed it last year. They can't refinance it. And what's interesting, I don't want to beat this High Peak dead horse, is that this comes on the heel of 3 other issues we've seen. I'm going to try to drive this from debt to equity. And that we've seen notes here in the last couple months from Ovintiv, Civitas, and Earthstone price at numbers that are not what I'm accustomed to for most of my career, certainly during the Shale era. Ovintiv, the biggest of the 3, got the lowest rates between 5.5% and 7.1%. And these are notes going from 25 to 2053. You come up here, so Ovintiv, I'm going to comp this to market cap, and I've got somewhere where I'm going here, so bear with me. Civitas, $5.5 billion market cap. Mm-hmm. They were doing this acquisition as well. They were coming out. They did $1.35 billion in notes, 2028 and 2031, 8.4 and 8.75%.
And trading a touch above par. So those as of recording. So just for those listening, those coupons are roughly where everything's yielding still.
Fair, thank you. So I've gone from 5.5 to 7 for Ovintiv, 8.4 to 8.75 for a Civitas, and then Earthstone, this small cap that's trying to get bigger in the Delaware. They did $500 million of notes due 2031 at 9.875. I mean, people are placing notes. I'd call it 10%. That's a tough nut to crack.
Nuts.
And that got me thinking, they're lower the market cap here, higher the cost of debt. And I went and I looked at the cost of equity. And you keep throwing out 3 times because that's where a lot of these companies are trading. There is now a pronounced correlation between market cap and their EBITDA multiple. And your small guys are all congregating here in this 3 multiple range. You got some that are like 2, some real lower quality names, and up to like 3.5. But that's the small guys are trading at lower multiples. And why this is an interesting observation is that it's counter to how the trend has been throughout most of shale. In the early days of shale, for the first 7-8 years, small caps got a premium multiple to the large caps. They ostensibly had more growth and more inventory. You're paying them for growth. And now, for the first time in a long time, that has inflected. Your larger, more stable guys have higher multiples than the little guys. They have a lower cost of equity and a lower cost of debt. In my mind, you tell me, John, this tells me the market is asking these little guys, do you need to be here? Why are you here?
Yeah. Yeah, I know. I agree. There's still way too many tickers. And the complication, to your point, it's the Civitas, Earthstone, all these guys, they're not big, but they're not micro caps either. So when you start saying, well, what if this guy at $1 billion merges with this guy at $1 billion, the market is saying, well, that's not big enough. Who cares? So like you start saying, well, geez, for us to hurdle rate this cost of debt, like the synergy number might even be more massive than 100% of C.
It has to be.
Like it has to be. So all of a sudden you end up with, absent a big move in the rate market, which clearly is not in anyone's control, we still on this pod, it's going to be really tough to do even the basic, well, hey, okay, we'll force consolidation. Maybe an activist gets involved and tells the guy who's a little bigger than the guys that are smaller to buy all the little smaller guys. Like we're not even there yet on like what is the amount where the market, I don't think we know where the market exactly cares yet, because it's telling you, man, we're double digits fast. Like, so I don't know how you necessarily resolve this. And then just as importantly, it's telling, again, love them or hate them, whether or not they've done stupid M&A deals in the past. Every banker in the world is going to tell Exxon and Chevron, these guys are all going to melt if you don't buy them. So like, you don't feel ashamed if you tell me to downbid them.
Like, has to be going on.
If you're a banker, you tell me you want me to put in a bid where maybe 8 years ago I would have said, yeah, I can't go to them with this. Like, tell me anything. I can go with them with that. And there's no shame in any number you give me. And they know it. I know it. You're in the catbird seat. You're flush with cash because you didn't nuke your balance sheet on all this other stuff. You're diversified. You're big. The market loves your bonds. You've got the nuts here. You tell me. And so, we're only 4 months past, the PXD rumor. And I know PXD is not a micro cap at all. But even so, it just shows the dynamic, how quickly you just have to, the dynamics been brought into focus. Like, yeah, it helps to be big, but the bar for being considered big just seems to keep growing and growing up to really only a couple of
That's exactly right. I looked, a little while ago, and the cost of equity was so different from the large caps and small caps that Exxon can buy any E&P out there except for Hess and make it accretive under pretty conservative. I'm using the Chevron PDC synergies number. That's how wide the cost of capital is. And my expectation is the longer this goes, the wider that cost of capital disparity is going to be, because they started off by offering 3 times and capturing that arbitrage. I expect it to widen and further incentivize them to take on the next tier down of companies.
Well, and again, I think that this is, to tie it all in, this is the point, right? These guys are making the wrong stuff, and we've capitalized them to incentivize them to make more of the wrong stuff. The right stuff is really the gas and the NGLs at a much more measured pace with a little bit of oil, keeping the prices high of all three and allowing it to grow at the same pace that your infrastructure does. And instead, they've gunned it for oil, which the refiners are telling them they don't need any more of, which the rest of the world is telling them they'd rather have the NGLs. And everybody's wrong way on this. And so the market's saying, maybe if a couple of you guys evaporate, who cares? Who cares? And if you're someone who trades the physical commodity, you'd love that, right? I mean, this is going to hang on U.S. energy, and WTI's 38 to 42 spec. Sorry, 37 to 42 spec. And you would love to just get rid of a bunch of guys pumping out 45, 46. Just like whittle it away, whittle it away, whittle it away. I just think everybody, whether they want to admit it or not, is incentivized to let a couple of these names drown. And I think the guys who sold first, it's always guys we always talk about that seem to understand this way before the other guys do. We had everyone getting out of stuff. Ranger Baytex just closed. These deals you just mentioned, they're going to be like, dude,
yeah, you got the pick of the litter.
Gone. We're gone. We're out of here, and we will start, working on the next trade with a full bank account at a clean conscience and see where this goes. And the guys, public and private, if you're still wearing a lot of this stuff, I think the financing market is not at these rates, just doesn't keep you alive. For companies that we're all from the beginning of our careers, PV10, well, 10+% bonds. Don't tell me PV10 matters. It just doesn't. And so the math that you did and just shared with us, I think that's something that, again, we can all be cynical about Exxon and Chevron and the things they do. They can do that math. Their guys do that math. And so they know. And if you're not adding any strategic value to one of these big guys.
Yeah, each of these deals that I mentioned put in their press release or their slide deck that they were buying them at plus or minus 3 times. Like, you should probably not advertise that, actually, because it's a terrible mark for everybody. And what I'm continuing to wrestle with is that for the bulk of my career, the takeout was positive. You want it to be long to takeout, and now, not now. Like, you're getting a pittance of a premium after your stock has been destroyed. You don't want to be long the name getting taken out. You want to be long the acquirer, and that's a flip of how conventional thinking has been.
Which means that if anyone's listening to this that works at the pod, sit down with your financials guys, because during the financial crisis and then recently, the bank take under, those guys know how to trade take unders. There are tons of take unders at financials. So maybe we should see if we could scare up a financials guy to write a how-to primer for the energy space on take unders and the emotional fallout, learning to love again. Take unders and learning to love again. U.S. shale in the 2020s. I'm okay, you're okay. Oh, man. Oh, it's going to be nuts. Yeah, this cost of capital thing, again, it is amazing how quickly a lot of the shale players put themselves back in a situation where capital is.
Yes, just right away. In this broader context, as we keep talking about, just as this trend of shrinking balance sheets has reversed, net debt has bottomed and is going up for the group, just as the cost of capital is going up as well. It's a tough recipe.
And as I said, and I know it was cynical, but it's true. That was the last quarter where you got to market off of good LTM numbers.
That's right.
As of today, Q2 2022 is not in your LTM number, and you're replacing it with a much worse. And by October, Q3 2023 will not be in your LTM number. And we're just starting, but as of now, you'll be replacing with something much worse. And so, good luck. Good luck. The momentum's going the wrong way. Your ratios are going the wrong way. You and I on, God, social media is nothing but charts of LTM free cash flow yields. And it's like, can you believe people are buying Apple and not buying this? Like, yes, actually I can. I have no view on Apple, but I can absolutely believe people are buying Apple and not buying this. I don't have anything keeping me up at night about that. So we'll see that. I getting the sense we'll probably see far fewer of those charts coming, hey, everybody, how are people like in Major League when Charlie Sheen can't hit the plate and Euchre's going ball 4, ball 8. How are they laying off such close pitches? Like, This has been, how are they laying off such high free cash flow yields? Because they ain't high. Got to be forward looking. Stop looking in the rearview mirror. I know we're entering earnings season, which is, for the rearview mirror crowd, their holy time. But you really have to look forward, and the forward free cash flow yields on the sector have stunk. And at these types of rig counts, I know we've dropped some, but we're still going full bore on the Permian. We're still, the primary vision frac count is 260. It's still a very high number, and focus still on NGL and oil, quote unquote, oil heavy areas. So the sector is not giving itself any relief anytime soon. And then the capital markets is telling you, to your point, that they're not there to bail you out either. They're not going to do the whole, for your years, you're right. Oh, how crappy are you? Well, 3%. Like, of course, everyone stayed alive at 3%. The guys asked no questions. Equity market was there, 3%. Boom, everyone stays alive. At 10% plus, it's going to get real dicey real fast. So should be fun. All right. Well, listen, we're coming up on an hour. Thanks again for listening to the Diff. Please subscribe to the Primary Vision Network if you're watching on YouTube or wherever you get your social media. I'm John Reilly at Ovington Asset Management at Ovington AM, joined as always by Greg Bordelon. Greg, I've been asked to ask you about social media.
I'm going to figure it out, John. I'll probably put something up there.
You don't have to. I know it's a cesspool. But at TBD on Greg's social media presence. Maybe try Threads.
Yeah, I thought there was an anti-oil and gas bias, but I'll take another look.
Exactly. So listen, hopefully you enjoyed this. Hopefully this is helpful. We'll be continuing these conversations going forward, and we look forward to discussing there's never boring in energy. So we look forward to discussing all the fun stuff that's about to occur in the weeks and months ahead. Thanks again for joining us. This has been the Diff on Primary Vision, and we'll see you soon.